my goal is, for one, to help them with the mindset, and we can jump into that a little more. But then the second thing is really as a mentor to elevate this to kind of like an educational level. So yes, in the first year, it's quite intense.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, we've got a great episode of the Alternative Investor Mastermind today. Interviewed Dr. Alex Meierhoefer. He talked a lot about his journey into passive investing, primarily focusing on turnkey rentals. We also talked a bit about AI and how that may affect jobs and future growth and productivity, and even dove a little bit into the U.S. dollar and the U.S.'s place in the world order going forward. So a really great episode and conversation. You should definitely check it out. Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Excited to have our guest today, Dr. Axel Meierhoefer. Dr. Axel, thanks for being with us.
Yeah, Jack, thanks for having me on your show.
Yeah, so I had the pleasure of doing your podcast a few months ago, and I'm excited to have you on. Why don't you, if you can, just tell us your story about sort of your path into real estate and alternative investments.
Yeah, basically what happened is that I was in the military, stationed in the US, and retired from that when my flying career basically ended, and got kind of like an executive position in a software company, and they had these kind of 401k options and stuff like that. And it was at the time when the stock market had just crashed in the dot-com bubble, and I'm like, okay, well, I read everywhere, literally, like, stocks are crap and don't get into stocks, and look at how much money people lost and so forth. And I asked, can I do something else with this money that you're basically going to kind of help with, or, give part of my income? They said, no, if you want to do something else, you have to kind of figure it out on your own. And so I started studying and realized that a lot of successful people were basically investing in real estate. One of the main people that influenced me on that was actually Arnold, the Terminator, because I read that he had bought from his movie proceeds all kinds of residential real estate in California. And so I looked into that, pretty quickly realized, okay, California is too expensive for me, but real estate seems to be a really good thing to do. And that's how it started.
The Terminator, that's a great story. You don't want to be a girly man and be afraid to jump into passive income.
Yeah, actually there were some people who said when I said I'll be back that it sounded somewhat similar.
Oh, that's great. And with a technical or sub level. So you were actually a pilot?
Yes, I was flying for the Air Force. Yes.
Oh wow, that's great. So this may be a generalization, but it seems to me that a lot of the engineer type personalities sometimes have a harder time making the jump. Sometimes they'll suffer from a little bit of analysis paralysis. As someone from a bit of that background, how did you overcome that? And I know you do a lot of mindset yourself. How do you help those that are very detail oriented get over the hump to the point where they could actually take action?
Yeah, I mean, in all honesty, Jack, I'm not really sure that I can claim that I overcame it. But when you have it, or when you're suffering from it, or even if you don't, what I was looking for is, what are some of the measures that make it easy for especially in the beginning, for somebody who is not an expert yet, to say, is it even worth looking into this property or that property, this investment or that investment? And then the second thing, kind of like from this analysis starting point, was to say, okay, so how in the longer run, because these investments were obviously for retirement, and at the time I still had 25 years ahead of me, right? So how in the longer run can I actually make sure that this passive income stream that I'm looking for is going to develop? And what I found, maybe you could call it a little bit from the analysis side, even though I never really felt I was paralyzed by it, was that other than what most people say about real estate, looking at how much are the prices appreciating and what's the cost to buy and what's the cost to sell and so forth, which is actually somewhat similar if you really think about it, like stocks and other investments like that, I came to realize on this longer time trajectory, it's really more important what the performance is. Right. And so when I first started to keep it really easy, I looked around and read some stuff on Bigger Pockets and other places and found something that I could handle pretty easily as a starting point was the 1% rule. Right. So instead of saying, okay, I know everything about a property, which goes to this paralysis part, was for me to say, well, how can I rather quickly find out if something is worth even looking into it? And the 1% rule, just for those that are not necessarily familiar with it, if you find a property, let's say for $160,000 somewhere in the Midwest, you want to see if using nowadays, we would use some tools like Rentometer or Deal Check or something like that. What is in that area where this property is, what is a reasonable rent that you can expect to make? And so if that rent number in that area for that kind of a like 4-bedroom, 2-bath or 3-bedroom, 2-bath property is like 1,600, 1,700, 1,650, 1,620, then you know, okay, that's pretty close to 1% of my purchase price, right? If it's 160 and you can get 1,600 or 1,500, you're pretty close to 1%. And then to say, okay, now I can look further, you know, what's with traffic and what's with schools and all of that kind of stuff, which if you do this, and I teach this in our mentoring program, it really eliminates, I don't know, I've never really looked at it that deeply, but I would say way over 90% of everything that's out there. Right. And so that makes it much easier then to get started into, okay, I have identified a general location. I want to work, in our case, with turnkey providers because where we live is too expensive to make successful, well-performing investments. Well, if we go far away, like 1,000, 1,500 or more miles away from where we live, we have to have somebody who manages for us. And I have found, and this has proven out for myself and for our clients, that if you get somebody to manage your property who is also the one who renovated it originally, then there's just you mentioned mindset, there's a psychological connection, right? Like if you do something where you know in 3 to 6 months from now, my company is going to be the one who has to fix anything that's not working, you just do it a little differently than a flipper who's just putting it together, making nice pictures, selling it to you, and then never has to hear about it again.
Yeah, that's such a great point on the one thing. And you know, I've worked a bit with Eddie Wilson, who is a business coach, and when he looks at key KPIs for a business, you know, he has a concept called the brick. You know, EOS has rocks, but you know, he has a brick, and it's really that one KPI that you could look at over and above the rest of the business. And one of the examples he gave was Foot Locker, the shoe store in the mall. They eventually realized that when they use that measuring thing to measure the size of your foot, the more they actually measured people's feet, the more shoes they sold, regardless of all the other noise, 50 other things they could track. And so honing into that one thing, and you know, for rentals, that one, for single family, that rentals, that 1% rule is great. It eliminates a lot of the noise. On syndications and multifamily, it can be value add. How much rent are you increasing per unit? I mean, there's obviously cap rates and a million other scenarios, but yeah, I find myself sort of honing in at least on generally one or two things right off the bat naturally. So you just made me feel good that I was doing it. And I'm not an analysis paralysis. I tend to be a ready, fire, aim guy.
Yeah. Well, I mean, the thing is also, and this is, you know, sometimes people ask me, how can you have a mentoring program at Idea Wealth Grower where people can sign up for a lifetime mentorship at a fixed price? They pay once and then they are clients for life. And I always say, well, my goal is for one, to help them with the mindset, and we can jump into that a little more. But then the second thing is really as a mentor to elevate this to kind of like an educational level. So yes, in the first year, it's quite intense. And oftentimes new clients want to buy at least 1 or 2 properties in the first year and understand why and how do I set up my protection and my company and maybe my estate plan and my trust and my savings process and all these many different things. But then if the educational component is working properly, as I'm really trying hard to do, then they learn with each purchase more and more what to look for, how to analyze it, how to determine which areas they want to be in. And this relationship goes from really intense holding the hand, having calls and emails almost daily and meetings every week or every other week, to less and less often, right? And then I transition oftentimes to more like, since we started with Arnold, I can say kind of like a protector situation, right? Where somebody says, I feel kind of confident I can do it now. It's my 3rd or 4th one. But there's one weird thing I haven't seen. Let me check with Axel what he says. Has he seen this before, right? Or other things where people say, okay, I got myself finally a bookkeeper and they want to use, QuickBooks. I have no idea what I should tell them how to set it up, right? And then they say, hey, we never talked about QuickBooks. Is that something you can tell me too? And the beauty is, since I'm doing the same thing, I have the same kind of company, the same kind of structure, the same kind of estate plan, the same kind of investing approach, sharing all their properties with anybody who wants to see it. So the chances are pretty high that I either have seen it or that some people in my network, I don't mean clients, but I have a pretty big network for lenders and insurers and turnkey providers, that I can say, oh yeah, I don't know this one, but I call Brian and Brian knows, or I call Jack because Jack is the guy who knows this kind of stuff. Right? So.
Yeah, and what's got to be great too is some of the people, as they get enough experience, probably even contribute back to the community. If they find a new turnkey provider or they find another vendor, they actually can contribute to teach you something, or at least bring you a new opportunity that maybe is a benefit to the rest of the community as well.
Yeah, absolutely. And it goes actually both ways. I mean, the one thing, the referral side is awesome. And I'm really, really grateful that some of the clients, and I think it's normal, it's kind of like, I call it the Tesla syndrome, right? They never advertise. They just get a Tesla and then show everybody and their friend how it is driving one, and then people say, oh, that's cool, I want one too, right? And in a way, not at that scale, but in a way, our clients, when they have gotten the first or second property, they obviously tell friends and family, and so we get some of that through those kind of referrals to grow what I call the tribe. The other thing is also that the relationships that I have developed on behalf for myself originally, but then also on behalf of the tribe members, that they come up with new stuff, right? Like, just to give you a quick example, one of my property managers who specializes on short-term rental property management found a way, I would put it, to engage not just through VRBO and Airbnb, but also to more affluent clients who have some more special needs, right? Like when they, for example, the supporting crew that comes in town with an artist who is kind of putting on a huge show or something like that. They come typically like up to a week before. They want to stay in nice digs, so to speak. They're also willing to pay a little more. And he groomed these kind of relationships and then realized, okay, if I want to really offer them short-term rentals that are a little nicer, then we need to basically create them. And the bank said, well, but there's only so much money that we can give you, right? You come to a limit. That's pretty typical. So he came up with the idea and approached me and others and said, hey, you're teaching your guys to create this LLC in which they basically do their operations and hold their properties. I have an idea where every time I get a new property, we put it in 50% my LLC and 50% either in my own or, like a client's LLC. Then both LLCs own the property together. I manage it. And obviously, I'm highly motivated to manage it well, because if I don't make money, then the other side doesn't make money and vice versa, right? So I thought that was a brilliant idea. We have now the first members in the tribe who actually do this, and I didn't come up with it. He is the expert in short-term rental management, and he just looked at how can we make this so that I'm not flaming out on funding too soon, right? And now that the two LLCs build together 50-50 partnership and there's a private lender in the background, it's cool.
That's great. It's a very timely time to have the discussion about private money, creative financing, just given what's happened in the last year with interest rates and bank failures and like a tightening of credit available from mainstream commercial banks. Perhaps can you talk? I mean, you've been through a few cycles already with Turnkey. What has it been like the last few years as far as pricing and rates of return? How has that changed as rates have moved over the last year?
Yeah, I love that question. Thank you, Jack, for asking that question, because I really think and I very much agree that there were some really interesting developments and how quickly they changed. The first one I saw was when money was really cheap and real estate was in because the media drummed the drums, not so much for an investing perspective, but every time there were 50 people lining up that wanted to buy a house, it was somewhere in the local news and stuff. So real estate became much more obvious and open to the broad public, which led to the fact that people started thinking about real estate investing and not just getting another house, which led for the turnkey providers to say, well, in the past, we were mainly focusing on investors who wanted to use leverage, meaning financing. And all the pro formas always used to have, here is what it is if you buy it cash, and here is what it is when you do financing with 20% down or 25% down. And they focused their cash flow calculations on the latter. And so in this time, I would say like 2021, about from the middle of 21 to the middle of 22, they had so many people coming to them that they were basically in the position to say, if at all possible, we sell this stuff for cash. Right? So that was one development. Now, as soon as the Fed in early 22 started increasing interest rates, people got a little scared and the cash buyers went away. Right? Because a lot of the cash buyers, they used to put their money in like CDs and stuff like that, and they just looked for something else that paid at least a little bit, right? But was reasonably liquid, and they knew, okay, real estate is not really that liquid, but it pays way more than what I get in any savings account, CD, or what have you, right? So they had originally discovered real estate, but not for the purpose of really long-term being in real estate. So when interest rates started rising and they could get like 6 months or 1 year or 2 year treasuries for like 3, 4, 5%, they obviously switched back and no more cash. So then the turnkey providers went back to finance deal performers, which was still possible, I would say, until like the third quarter of 22, when the interest rates really started running away. And this whole notion like that you had to be really fast if they had a deal that they offered that was close to the 1% rule, as we discussed earlier. They basically, I remember many cases where I got the pro forma and in the email it said, well, we can give you 3 days to decide if you want it. Well, not necessarily recognizing, okay, well, I got it now. I have to engage my tribe members. I got to give them at least a little bit of time if anybody wants it, and then get back to you in basically 72 hours. That all went away. Now we're at a point where you see turnkey providers to say, okay, well, we give you the first year of property management for free, and we're willing to buy down some of the closing costs or free closing costs, or even buy down the interest rate. I had like one tribe member now get 100% financing, first year free property management, and the property for like pretty close to 1%. Now, 100% financing is obviously not cash flow positive, but it's literally a brand new house that was originally built for families in the area to buy, and they all don't qualify anymore. So investors are kind of like the last one standing, who obviously qualify because they don't qualify on their income, they qualify on the performance, right? So that's a huge change from if you weren't fast enough, the turnkey provider or any kind of seller just moved on. Like we have thousands of people lined up on the street to what can we do to get you to buy anything? So, and that makes it even more important, like we said earlier, to really look at the deal, have some criteria to look at it early, to decide, is it even worth spending time on it?
Yeah. So if you could, at least high level, how did that 100% financing work out? Was that seller financing? Was there a bank loan with a concession?
No, what actually happened is that the builder had gotten, as far as I know, the builder got the construction financing for the whole neighborhood. Like, I don't know how many units, but quite a few, probably something like 80 or 100 brand new houses that were basically in an A-class neighborhood intended to sell to local people who were looking for a new house. And when that builder realized that they wouldn't be finding enough people that would qualify, there were even cases where people had already signed the contract and then the bank said, no, we can't do it anymore because we went from like 2% financing to now 6.5% financing or something, like for owner occupied. So the builder went to his bank and said, well, what do? We can't just let them all sit here finishing one after the next, and they just sit here. Can you help us out? Right? And the bank said, well, we know that these are good properties. We know that they will appreciate over time. So what would help? And so the deal was basically, yes, we give 100% financing, but the people need to basically show that they are able to pay the negative cash flow. But when you're an investor, and especially if it's not your first property, like the investor the first one that actually got the deal, and these deals went pretty fast, to be honest, that was his fourth property, right? So he could easily show that just out of the positive cash flow of his other three properties, he could pay the negative cash flow, not even having to take anything out of his own pocket, right? And so there were some additional criteria, but for an investor who is not novice state first property, but a little bit further ahead, that was a great deal. And the calculation for the audience, if you ask yourself, okay, how is this ever going to be a good deal, right? So we calculated that a modest increase in rent, something like $50 a month or so, would lead in about 6 years to break even if this 100% financing at these relatively elevated rates would never change. Now, obviously, the assumption is, and I'm willing to go to bet to that within those 5 years, probably sooner than at the end of those 5 years, interest rates will have to come down again. And so what you would do then is you basically refinance the property to something more reasonable, like in the 4% range. And then you basically cash flow positive. And since this is like an A-class neighborhood, you have a reasonable expectation that you will have some appreciation. So if you take a real example and you say, okay, it's a $250,000 property that appreciates, let's say, 4% per year. So that's 20% in roughly, not really using a calculator, 20% in 5 years. And you refinance, your 20% down payment is basically built in, right? Because you wouldn't refinance to 100%, you would refinance to a traditional deal with 20%, but it's already equity sitting in the place. And and then you basically start making the positive cash flow. As a brand new house, it's still going to appreciate continuously going forward. It's in a great neighborhood. And and so basically at that point, you start making money on it. You're still making equity on it. You still got your depreciation benefits the whole time, right? The 5 years, even if it was negative. The other thing is there's a little bit of an interesting component is we obviously teach our mentoring clients not only how or help them how to buy properties, but we also teach them how to create their own, what we call series LLC structure. So the company that is basically managing that asset as part of the series has basically losses because it pays the negative cash flow. And if it's an S Corp, which we recommend, then those losses from that operations company transfer over to your 1040 tax return, and you get at least some of that back.
Yeah, love taking paper tax losses for sure.
Yeah.
Do you know, is anyone doing cost segregation on single family? I've heard that if you do it in bulk, it can be sometimes worth it depending on the price of the house and if you got the right vendor that because single families are relatively cookie cutter.
Yeah, I have not really seen anybody really go through with it. The one time I've seen it basically being applied was when and this is super, super rare. I wish it would be much, much more common. When the builder, this is especially doable on brand new properties, when the builder is diligent with keeping the records, right? Because imagine you have a builder, and when they basically do the structure, they can say, okay, this is what we put in the wood in the walls and the drywall and the paint and the all the different things, the concrete foundation, the pipes and so forth. And this is everything that builds the structure except for the roof, let's say, is 40,000. And we have all the receipts. And then we have the roof and we have all the receipts, and that's 10,000. And then we have all these other things and we have all the receipts, right? If you have a builder, and I've only seen it once, where the builder basically, not with the intention of cost segregation, but with the intention of just tracking what are all the different components that ultimately made the cost of the house, then you don't really need to even bring a cost segregation appraiser anymore. You can just basically send them the spreadsheet and say, here is the binder with all the receipts and here are all the numbers. It's already segregated if you want to. The only thing that they then have to do is to say, okay, what are the different items? And this is a CPA exercise for the CPA to say, okay, well, which item has what kind of depreciation term? Like an air conditioning is maybe 15 years or so, and a roof is 25 years, and the walls are probably 27 years, and I don't know, the fridge is like 7 years these days or something like that, So as long as you have somebody who knows what the depreciation timeframes are for the different items, that was brilliant. But those builders that really keep the records this well are rare. And I also like to bring it up for your audience, because if you ever have the chance to get involved in a deal where you're actually working directly with the builder, to get that information also includes, I'm a huge fan, even though it's super, super rare, for the builders to get on anything that could conceivably break, things that tenants would use to get the extended warranties. Right. I once, this tells you why I was hesitant to say I overcome my analysis paralysis kind of tendencies. I once went to Lowe's, sat down with them and said, okay, here is all the stuff, right? Like all the appliances, the light fixtures, all the things that kind of typically break, faucets, stuff like that. If I buy all of this and I buy all the extended warranties that your warranty provider is offering, how much would the total cost? And depending on which kind of sophistication level, it was between $1,000 and $2,000. Right. So if you really think about it, on everything, you would have, like, instead of 5 years on the fridge, you would have like 8 years, or the air conditioning, you would have 15 years, the water heater, you would have 10 years and stuff. From an investor perspective, that would be so awesome, because whenever property management says, hey, your tenant just reported that the fridge is crapping out and it's 5 years old, you just say, hey, here's the warranty, get a new one, or let them fix it. Free, right? You never really have to tap into your maintenance reserves, but it's very hard to get anybody to really do it that diligently. You need kind of somebody with analysis paralysis too.
Yeah, no, that's great. I mean, just from cars, just buying cars, it's kind of in my head that the warranty is always a ripoff just because of auto dealerships. But on the house, It makes a lot more sense, especially as an investment property.
Well, yeah, and that's that last half sentence you just said. That's the important thing. It's a ripoff when you are an owner occupant, or if you buy it for yourself for your own use, right? But when the choice is, okay, property management says the refrigerator or the range or something like that is reported to have an issue, and it's 2 years old, and that's when the manufacturer's warranty ran out. If you don't have these extended warranties, you know that you either pay for a new one or you pay for the repair, which oftentimes nowadays is, okay, they charge you $100 just to show up, right? And then they look at it and they say, yeah, there's a part that I don't have, so I have to go back and come again, and it's another $50 to show up, and then the $10 part, and then a half an hour to put it in. So you're paying always $250, $300 for even the simplest fill in the blanks, bad word kind of stuff, right? so, if you compare that to say, hey, just put the warranty documents all into your document folder for your owner's manual that basically any good property manager have in Appfolio or Buildium or something like that. And when anything breaks and the tenant reports it, you just pull it up, call the company, let them fix it, and it's free for you as an investor. So for the investor, I would recommend to try to make it work. It's just so hard because it needs somebody with the same mindset on the other side.
It's great. It's a really really cool tip there. I appreciate that. I want to ask more about the different markets you're in. You mentioned early on that at least at the beginning, it was hard to find anything that cash flowed in California. How many markets have you invested in, and what are a couple of your top markets right now that you like and that you're focused on?
Yeah, so we basically right now in 4.5, 5 markets. It sounds a little weird, but I started out in what I always called like west of Chicago. That was basically like in the Quad City area around Davenport. At the time, that was an area that was very stable, which was my first initial thing to look for, is an area that is stable, so it doesn't go up like crazy, but it also doesn't go down like crazy. So it's relatively safe to invest in a renovated property and hold it for 30 years or longer. So that was the first market, and it's right at the border between Illinois and Idaho. Then the second market was Ohio, and it's still one of our strongest markets, anywhere between Dayton, Cincinnati, Cleveland, Akron, those kind of places, Columbus. Then the third market that I'm invested in is in the Austin, Texas area. Although this is not single family because that's too expensive, we invested there in a syndication for a new build apartment complex like 2 miles north of the Tesla factory. So, that's a little bit giving you an idea what are drivers to look for. And I don't like the laws in Texas very much about, like how they do property tax calculations and stuff. But Austin is the fastest growing city in the whole country, and that area around the Tesla factory is Boomtown, USA, basically. So having an opportunity to do that was great. Then the third one is Florida, kind of like, providing living space for the New Yorkers is what I call it.
I think... Yeah, so it sounds like you've got some good diversification. You've got that kind of slow and steady Midwest, and there's a place for just areas that have significant population growth and just growth of, especially people coming in with resources, money. And Florida has also the retirees plus just that whole unlocking of a little bit more remote work, and we'll see what happens long term with remote work at offices, but. At a minimum, a few percent or more of people are now able to work remote that wouldn't have. I don't think it goes back. That you can't get that genie back in the bottle, in my opinion. I don't know what
totally
your thoughts are on that.
I absolutely agree. Actually, I'm even a little more optimistic because we're seeing the first glimpses. If you ask me, what's my outlook, the first glimpses that we see is all this hype around AI, and the stuff we see right now is only very, very remotely relevant for our real estate investing. But what I'm actually seeing is that the tools that come out of that will become more and more useful and more interactive, where you actually have to ask or answer the question, is the role, regardless whether the person is sitting in a cubicle or in an office at their own house, is that role going to continue to be there or not? Right? And I can see so many roles that aren't going to be there anymore. But then I can also remember that when we had other technology transitions, that oftentimes, I'm sure your audience is going to chuckle a little bit about it. Remember when computers were coming out and everybody was talking about the paperless office, right? And my wife tells me, we're using more paper now in the office than before the paperless office. Sometimes the predictions are wrong, even though everybody is now doing what you and I are doing. We're connected long distance, we're doing video conferencing, we're allowing other people to listen to it. So these technology transfers are, in my opinion, not automatically destroying employment. They just basically transition and transforming it. And so the things that we're imagining now, where we say, do I need team meetings? right? Well, if if you are the lead manager on a project that is conducted by 15 robots, they can be anywhere, and you can also be anywhere, right? But right now, it's kind of hard to imagine that the workers that you're actually managing and leading are not really humans.
Yeah, that's true. It does give me a little concern about, you said, as you mentioned, almost every cycle so far, there's been new jobs that are created, and sometimes there's a bit of a lost. I was up in Michigan for an event, and it's thought of Detroit, where there was kind of a lost generation of people when some of the auto jobs moved offshore or to the south, but downtown Detroit now, there was Quicken Loans, and there's a new slew of companies. And then the younger generation, there's kind of new companies providing new jobs in a market that was incredibly cheap to live. So things seem to have their way of working out. But my fear is this time it may be a little different just because of the level of automation. Granted, you still need humans to put the prompts in. And, what are you have any fear of sort of lack of jobs or,
No, actually,
anything different this time around?
I don't think it's different this time around for one reason. If you look at a really long arc, if you take like Ray Dalio's, for example, the New World Order is a great book to read, or The Fourth Turning, or some other books like that look really over a long historic period in the sense of economic development. And what I found is that we're looking at it through a human lens typically, rather than from an economic perspective to look at it from a productivity lens, right? And so if you say, okay, well, if we have an office worker who is working, let's say 8 hours per day, 40 hours or 50 hours per week, they can have a certain level of productivity. Let's assume you could increase this to like 160 hours per week, because you have robots that only need to charge every 8 hours for an hour or something like that. Right, but the rest of the time they can be productive. What that means is not that they replace automatically 3 humans, they just increase productivity 3-fold, right? And so the remaining or the existing humans, if you want to, are basically managing a much, much higher level of productivity. And that sounds a little abstract right now, but imagine back to when we had very little machinery in agriculture. But everything was basically done by hand. The sowing was done by hand, the harvesting, the watering, the weeding, everything was done by hand. And then machines came and productivity increased massively, right? And then we increased it so much that you didn't need the people anymore. So they took their abilities and went into other industries that we didn't even imagine would ever be existing. Right, and the overall productivity of a country and economy or the globe, if you want to, increase massively to things that you and I feel are normal, until you go into places that are not nearly as far developed as we are. Economically, financially, digitally, production, all those kind of things. So I believe that the increase in productivity that these new technologies bring does not mean that the people that we have will nothing to do anymore. They will just have to do other different things utilizing this increase in productivity. And I'm not claiming to have any idea how far this is going to go, but I give you one example that I'm craving and hoping that these AI experts solve quickly. There are so many things where I'm finding my own limitations, either in speed or in accuracy and stuff like that, when I do the job I do, where I wish I could just tell the thing, like Tesla calls it Optimus, right? When I could say, Optimus, come, or talk to Optimus like you and I are talking, to do the things I want to get done. Because my fingers typing is not just slow, but it's also very inaccurate. And to understand for the other side, if you look at the statistics, 83% of emails are misunderstood. Right? So text is anyway not really a good way, and there's very little learning when people get a little bit on how you express yourself, but there is not much learning when you send emails back and forth. Now imagine you had somebody who could learn how Jack operates and talks and what he really means in his language, or how Axel or anybody else for that matter, and you just give the command and then they don't do it. And initially you would say, show me before you send it, or show me before you do it. And sooner or later you can gain the confidence. This is what I experienced when I went from just doing all my work myself to starting to have a team for video editing, for like a executive assistant, for bookkeeping and so forth. And now all these other, you build a certain level of trust. I can totally see that level of trust could also happen to an artificial entity over time. And I could do so much more if I only had to say, do it and describe it a little bit in 30 seconds. And then I knew, okay, it's done, and it's done 24/7. Just imagine marketing and sales. If you could tell them what to do, right? and they make no mistakes. They have no typos. They don't put the wrong date or the wrong start time or what have you. There's all kinds of stuff I can imagine that we're just starting to see first glimpses. And the real trigger that I believe for the audience to pay attention to is everybody speaks about large language models. To me, this is super exciting because I think language is the next thing before Elon or puts a plug in our brains. Until that happens, I think language will be the next productivity multiplier.
Yeah, it's already, I've used Google Translate in many countries where you could even scan a menu. You could have a menu in Mandarin and you just hold your phone over it and it will translate it into English for you. That's been around for a few years already. I've heard those next versions of ChatGPT and all the plugins and APIs are, incredible, just from asking and getting an answer to having it go and fill in web forms or create in Excel and code. It is really, really incredible. And, just to avoid, I'm not a doomsday guy by any means. There's moments I listen to a little too much Peter Schiff and I worry about sort of, the dollar and the U.S. place in the world. But I've just discovered Peter Zeihan over the last year, and he points out a lot of positive things. The U.S. is one of the only countries that's food and energy independent, and we're still, in a pretty, strong place in the world. So I think as if you look at the .com era, that was one of the few years we actually had a budget surplus in the last 40 plus years, just because of the technology and the the way we were able to capitalize it. And the internet was ultimately really good for productivity, and a lot of people made a lot of money, even with the .com crash included.
Absolutely.
We're all in a better place.
I think what's important for the audience or anybody who is willing to listen or interested on a little bit of a bigger picture is it is hard when you're in the fortunate position to say, okay, well, as long as I can remember, we are in the leading position in the world. Right now, when I say as long as I can remember, that means like maybe 50 years back, or if you really go all the way to World War II, what is it now, like 80 years or something like that, maybe a little more. So, it's kind of like 3 generations where the US was based on military and economic power at the top. That's why I mentioned earlier, I encourage everybody to hopefully be willing to get a little bit more of a longer term economic and historical perspective. And when you look at that, even 100 years is not really that long in the bigger scheme. And to what you just said, Jack, I'm a little worried if as much as I'm optimistic for the technology and what it can do and productivity gains, I'm a little worried that from our current lead position, that we are kind of stuck in our political and military-based power, right? And I can see that people around the rest of the world, these other 191 countries or whatever are out there, or a lot of them at least, say, we don't want to always do it the way the United States says it needs to be done, or says, okay, this company can do business, this company can't do business. We're not, just to give like quick examples, we're not using the best mobile phone technology because the best one is made by Huawei. But politically, we're saying, no, we don't want to do anything with China because it makes them stronger. So we're willing to use less advanced technology. While if you go to 190 or 180 other countries in the world and somebody comes and says, okay, you want the best most modern available mobile phone technology, especially when they're just coming out of the agricultural age, they will most likely say yes. Now, that's just one little example. So to assume that we will always be in the lead just because that's the only thing that we can really remember in our lifetime, I think is a little bit of a fallacy. And this technology is in a sense liberating because, as you and I can see, we're showing this on a daily basis, even on the small scale already. You and I can be at totally different locations at totally different time zones and have this conversation and do something worthwhile. Well, imagine you don't even have to look at the time of the day because the robot is working 23 hours out of 24, right? So that there is so much potential there that I hope those in power are a little careful to apply the old paradigm. Like I feel like we're still applying the 1980s, 1990s paradigm politically and economically to our current time. And, it would be sad if we give this leading position away, but I can also very clearly say that we might become something like Britain is now, or the Netherlands, and most people don't know the Netherlands were once a world power. Greece was a world power. Italy was a world power at the same scale like the United States, or Egypt before that was a world power at the for that time global scale. So, if we can update our approach to modern times, I think we have every chance to stay there. If not, which I'm really skeptical about right now, we might have to accept that others make better offers, and the world is shifting towards that direction.
Yeah, I definitely agree with you, and I share some of the same concerns. And down in Puerto Rico here, I'm surrounded by a lot of Bitcoin maximalists here too, and I look at that as another control. I know the SEC just cracked down again, and there needs to be some level of regulation to avoid the the scams and the things that happen like with FTX. But at the same time, this is probably the first time in history that a government may not have a monopoly on control of the currency. You couldn't take, you can't take like 10 pounds of gold and move it without the government knowing. But you could take $1 billion of Bitcoin on a USB drive, or theoretically, if you can memorize 26 words, you can go without anything and have complete control and autonomy over your money. So I mean, there's that's a whole other episode on its own right there.
No, I totally agree. But see, the thing about it is, Bitcoin is kind of like a trigger term, right? And even I have a little bit of Bitcoin, and I think it has a future. But when I talked earlier about productivity, there is nobody that I know that has a little bit of an understanding of the technology who wouldn't admit that blockchain is a massive productivity increase, right? So the fact that originally the cryptocurrencies were built on the blockchain is more coincidental. But the power of the technology that will also lead to the productivity increase, regardless which country you're in, is the blockchain. And obviously, when everything goes to like what's called Web3 and those kind of things on the blockchain, it also makes sense that we're utilizing that technology to make payments. I wouldn't be super surprised, again, last little prediction here for your audience for today, I wouldn't be surprised if before this year, 2023 is out, we will hear from the leaders of the BRICS country the announcement of a BRICS currency, which is probably going to be a digital currency, not a crypto, but probably a commodities-based BRICS currency, which then leads to, okay, everybody wants to join. That's already in the news. If they get to like 20 or 30 countries and they're all trading with the BRICS currency, right, then suddenly something like crypto, whether it's Bitcoin or Ethereum or so forth, makes much more sense because so many more people become familiar with it and see the benefits and the security and the lack of, what we basically did to Russia and scared the rest of the world in the process. So that would be, like you said, a totally other episode, maybe worthwhile, but there are a lot of these dynamics in play now, and that's why I'm so afraid that if we don't wake up and say our 80s, 90s philosophy that we still try to want to implement it around the world, people will say, kind of as they say in circles, in personal, private circles, they say, oh, this old fill-in-the-blanks person has these old opinions that have not been updated to the modern time. I would hate it if the US would be basically looked at in that way, right? We're still playing the Cold War while the rest of the world is moving on.
Yeah. Well, unfortunately, I'll probably take a crisis, and what do they say in politics? Never let a good crisis go to waste. But hopefully a pivot happens, and we can go get back in the right direction. Axel, how does everyone get a hold of you?
Yeah, absolutely. I mean, the easiest way is just go on Google or any kind of search engine and put in ideal wealth grower. And Ideal Wealth Grower, we use that across all social media. Idealwealthgrower.com is our website. As soon as you spend 30 seconds, it pops up and say, do you want to talk to Axel or do you want to join the newsletter? So, that's idealwealthgrower.com or just the term Ideal Wealth Grower. Or you can put all three words separately. You find us, no problem.
Great. And we'll certainly put it in the show notes as well. So really wonderful conversation. Thanks for coming on, and we'll do it again sometime.
Yeah, absolutely, Jack. If you and I need to talk about productivity and crypto, let's do it.
Awesome. Well, everyone, please subscribe on iTunes, YouTube, Spotify, or your podcast platform of choice. And we will see you again on the next episode. Thanks everybody.
Jack.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.